Hi, everyone. It's the Plant-Based Business Hour. I'm Elysabeth Alfano. It's great to have you with me today. So, just what is investing in plant-based innovation in the public markets? Is it Beyond Meat only? Is there anything else? Who else is making traction? Who else is big enough to have meaningful impact as we see these smaller startups fade away, get eaten up by larger companies, or maybe just dissolve altogether? They're not having the impact that one would hope they would have on global food systems transformation away from inefficient animal proteins. So, who is large enough to stay the course, weather a bad economy with a big team and a big distribution channel and huge advertising budgets? Who is large and in the public markets and being traded? What are the companies that we can invest in to meaningfully and impactfully shift the global food supply system away from animal proteins? Well, let's talk to Bloomberg Intelligence Senior Research Analyst Jen Bartashus. Jen, thanks for being on the Plant-Based Business Hour again.
Thank you so much, Elizabeth. I love being here with you.
Well, so kind of you. Okay, so maybe we should start at the very, very beginning. Is the plant-based sector in the public markets Beyond Meat and Oatly only?
No, it's not, and it's easy for people to forget that because those are the two companies that get the most headlines, and they get the most headlines because they're pure plays, and that's really all they do. And so people look at those companies as that benchmark of what's happening in the industry, but they are both small companies. They both are going through huge transformations of their business model, and so they've faced a lot of challenges that they're still working through. But in the broader market, you have companies like Ingredion or Givaudan that are there in the space as well, and not to mention some of the big packaged food companies like Nestle or even Kraft Heinz with their joint venture with the Natco. There are plenty of companies out there that are still investing in the space and are throughout the public markets without just being the focus of Beyond Meat and Oatly.
I love that you mentioned Ingredion and Givaudan because they're both so committed to plant-based proteins. Givaudan, for those who don't know, is a flavor and texture company. So they're really working to make plant-based items taste good so that consumers really want them. But at the same time, behind the scenes, they're spending CapEx. They're spending on infrastructure, on cultivated meat in Switzerland in a joint venture with Buehler, which makes food machines. A lot of the machines in factories that make plant-based meats. So Buehler and also Migros, which is the Swiss large retail grocer. The three of them are in a joint venture on cultivated meat. And then in the United States, they're doubling down on a plant-based innovation lab on the West Coast. So they have their business-to-business model, which is where we at VegTech Invest think all the growth is going to be. It's going to be really in that infrastructure. So they have their business-to-business clients working on food and flavor texture, but then they're also doubling down to be there to capture market share when things really shift. They're placing themselves for cultivated meat and plant-based innovation. So it's exciting to see. Jen, maybe you can talk to us a little bit about Heinz and Natco. So Natco was stealing all the headlines, I want to say, in 2021 with their Giuseppe AI. So they were doing AI before people, everyone was talking about AI. And that partnership with Heinz, I think, is so interesting. What are they doing together?
Well, I think what's really admirable is that Kraft Heinz, what they're doing with plant-based is a tiny part of their overall business at the moment, but they haven't backed away from where that can go in the future. And the joint venture with Natco is really a great example of that, where the company is committed to being able to eventually offer pure plant-based alternatives to things like their iconic mac and cheese product, right? And so the technology and the learnings that they're getting from Natco and that they're sharing with Natco as they're co-developing products, I think is a really good example for across the packaged food industry. On even though the opportunity is small today, the ability to integrate that into your innovation, integrate that into your thinking, is something that a lot of companies could pay attention to for tomorrow. And you mentioned Givaudan, or we talk about Ingredion, and that business-to-business model. I think the other thing that people don't necessarily appreciate is that when you look at Kraft Heinz and their joint venture with Natco, it doesn't have to be a product that is 100% plant-based either. They could selectively choose ingredients and start integrating them into hybrid products. And they could do that for a variety of reasons, whether it's just for taste or formulation or cost, whatever it may be. But there are more ways to bring plant-based into the mainstream than having only 100% plant-based products on the market. So I think there's just a lot of interesting things going on there to keep an eye on.
I agree with that. So for VegTech Invest, we really invest in the pure plays. So we're not investing in something like Heinz that really has a de minimis amount with their joint venture with Natco, but we're keeping an eye on these major players. Now you think of Heinz, they've got distribution channels, they've got ad budgets, they've got global teams. A recession, not going to phase them. They're not going to, they weather the storm quite easily, as do all the other companies that we mentioned, like Kellogg and Givaudan and Ingredion. And it's going to, they're the ones that in a way can make the real impact going forward. I know we all had our hopes on the small startups, but there's not the depth and breadth there to really make a difference in the global food supply system. So we don't invest in Heinz, but we keep our eye on them. What are some of the things that Kellogg's is up to? Now they have Morningstar, and Morningstar is not de minimis for them. It's actually a meaningful part of their business.
Yeah, so with Kellogg, I think one of the things that we're seeing is that the Morningstar Farms brand is just holding its share, right?
Yeah.
It's a long-term brand. It's got great brand recognition. A lot of consumers know it. It's easy to shop because it's very recognizable, and especially in the frozen foods aisle. And for Kellogg, when they announced that they were going to be splitting their company and going in a new direction. Originally, we thought that the plant-based segment or Morningstar Farms would become its own independent company. But now it's actually going to stay with the global snacking part of Kellogg, which is going to be called Kellanova. And actually, that's probably very good for Morningstar Farms in this environment, where they still will have the backing of a big company, as you said, Elizabeth, with good distribution, the presence at all, at all the different retailers, lots of food service engagement as well. And what we've seen with the Morningstar Farms brand is not only is their shareholding, but they've done some great innovation in the last couple of years, where it's keeping the assortment fresh and interesting for people who are loyal to that brand, who are shopping that aisle.
And we're always looking at Kellogg again, not a pure play, but we're always looking at them because they are going to cross over, I believe, at some point and be more of a pure play, particularly when I believe, now this is all speculation because nobody knows the future. I believe that it's the current market conditions that makes them not want to spin out Morningstar,
Exactly.
but at some point they will. I was actually on Bloomberg Intelligence with Eric, a colleague of yours, Bloomberg TV with on ETF, the ETF TV show, my word, with Eric, who's just so wonderful. And we were talking about how, Kellogg has the legacy business of cereal. Snacking is the business of today. It's how everyone eats. They eat standing up. They eat walking down the street.
Yep.
So snacking is how people actually eat. And then plant-based is the eating of tomorrow. And of course, market conditions has made them hold off on spinning that off. But I think ultimately they will do more and more plant-based innovation and more with Morningstar. Some folks on this show might know that I started my career at Kellogg's. So I ran Special K and Frosted Mini Wheats, and those are very fun brands to be on.
Yeah.
And Kellogg is a great company.
It is, and when the company does split, because Morningstar Farms is staying with Kellanova, it will comprise a decent amount of their total operations. So it will become a more important part of that Kellanova as well, and that means it should get the support it's for marketing and for innovation and things like that, so that when the market conditions are right, it will be in great shape to be eventually sold or spun off.
Well, I remember when working at the Kellogg company that one of the things we used to say all the time is there's a lot of equity in being first. And I think Kellogg's Morningstar, one of the OG of plant-based products. And I think they want to maintain that out in front for innovation and being known as a leader in the space. So I would look for more from them. When do you think that spin out is going to happen?
They're expecting it by the end of this year, so it will be happening in the next few months. So it will be a very exciting time. But to your point, Kellogg has also nurtured the brand. Whereas if you think about Boca Burger, which is another brand that's been around for forever, it's still there, but it hasn't been nurtured in the same way. and it hasn't really been raised the same way. So Kellogg's done a really great job of shepherding the brand and continuing to support it and grow it.
I believe it's been a point of pride for them. So it's been something they can really hang their hat on. Now, what about Gardein? I don't know. I didn't, in fairness to you, I didn't prep you on this one before, but do you cover ConAgra, and are you watching Gardein at all?
So we cover ConAgra at Bloomberg Intelligence. I don't personally cover that name, but with regards to the Gardein brand, what we've seen in terms of trends is that it's holding steady. And so, it's and in this environment, holding steady is a positive thing.
Yes, yeah.
And so, the performance there has been very reliable. Hasn't been growing like crazy, but it also hasn't been shrinking either. So to me, that just says that for the products that they have out there, consumers are engaged with them, and there's a good repeat purchase pace on those. But that being level is certainly key for ongoing success for them.
In this market, 100%. Again, at VegTech Invest, we don't invest in anything that isn't a pure play, but you can find your pure plays in unexpected places. So Givaudan, Ingredient, Oatly, Vitasoy out of Hong Kong. I mean, there's lots of great pure plays, but there's also some unexpected ones like AB InBev. So Jen, I don't think you cover them, but AB InBev, everybody, Anheuser-Busch. So their beers are vegan. Okay. But more importantly, and this is what we really look to see, because we really believe that it's the business to business infrastructure model that's going to provide returns in the future. AB InBev is the largest fermenter in the world. So who knows about fermenting alternative proteins any better than AB InBev? No one. So they have spun out a sister company. I mean, it's still under the AB InBev umbrella, called BioBrew. And they're working fast and furiously on brewing alternative proteins at a scale that's meaningful that a startup could never do. So there are some interesting players in the global world of plant-based innovation that people might not think about. And ultimately, it's like we were saying, the world of plant-based innovation in the public markets, which is where you can actually impact the global food supply system, is way more than just Beyond Meat and Oatly. Right. That said, let's do a deep dive. What did happen to Beyond Meat and Oatly? I get this question all the time, and I feel like I never do it justice. I want to hear it from a real analyst at Bloomberg Intelligence. What happened to Beyond Meat and what happened to Oatly?
So, as I said a little bit earlier, both of these companies are in the middle of a big transformation in terms of their business models. And so when you look back over the last 18 months, you've seen job cuts, you've seen, efforts to consolidate their co-manufacturing facility footprint. You've seen them have to kind of rethink their whole business model. And as part of that, they made some promises, in terms of where they thought they were going to be able to bring their business. And so if we start with Beyond Meat, the core platform of Beyond Meat remains a true innovator in the industry, and they have the ability to continue to blaze new trails, but the investment community had wanted to have a sense of when are they going to be cash flow positive. And the message from the management team was that it would happen in the second half of this year. Well, with the last earnings call, when they announced earnings, that has now been delayed. And that is what has caused the stock to really plummet on the heels of earnings. And so, they had to take a more conservative outlook for the rest of this year, because demand hasn't sprung back as quickly as they had hoped. And so there are a lot of things that are influencing the consumer at the moment. I think everyone has heard the headlines that consumers are under a lot of pressure, that's not really fading at anytime soon. And so what that really translated into is that demand hasn't been as strong as everyone hoped it would be. And so when demand isn't as strong, that means your top line isn't as strong, meaning your sales aren't growing at the same pace. And that means that you're not getting as much productivity out of your entire organization that you could be. And so I think that Beyond Meat is doing all the right things. It's just going to take them a little bit longer than they thought it was going to take to get the business to where that transformation is a little bit more complete. And that's what's really has driven that stock price down on the heels of earnings. And with Oatly, it's a very similar story. They had to do a transformation. They recalibrated their manufacturing footprint, and they've had to bring their costs way down. They've had a management change. Their CEO has changed, and so with Oatly, a bigger part of their story is about China. And China was much slower to reopen than anybody expected on the heels of the COVID closures, and that means that demand hasn't had that uptick that everybody was expecting. And so for Oatly, they had put a lot of eggs in that basket of China, and they were doing a lot of unique development of products specifically for that market that then just didn't materialize in terms of sales. So they're in the process of reformulating their strategy for Asia, and that's largely around China. And it's just going to take a little bit of time for it to play out. And so that's really what has driven the stock prices in the last couple of weeks. But when you think about long term, again, both of these companies, they have they know what they need to do. They just need the time for it to actually unfold and to be successful.
Mm-hmm. There's a lot that I want to unpack there. I mean, in many ways, just broad strokes, I think Oatly is very smart in going into Asia where the world is lactose intolerant. At least, I can't speak for Asia proper, but Asian Americans are almost 99% lactose intolerant, although the government markets milk to them and encourages them to have milk, but their systems can't handle it. So to go into Asia really loud and proud with oat milk, it's unfortunate that the COVID timings and that still held them back, because that seems like it would be a very smart play. And then
I will say, though, with regards to China, there may be an interesting lesson to be learned from the animal protein companies, in that we've seen Cargill sell their China chicken operations. We've heard rumors that Tyson may try to sell their China chicken operations. And the reason behind it is that domestic players are coming into the space and they're producing product much more cheaply than some of the international brands. So there's just something to keep an eye on for the companies like Oatly, where there may be a potential risk that a local Chinese player may say, well, we can make oat milk, and we can make oat milk cheaper than some of these foreign companies can. And so the strategy will have to be very specific, to be successful there, I think.
We'll see. I mean, one of the things I love about Oatly and where I think they really shine is their branding. And
Yes.
I think you can do that with milk in a way that you can't, like a commodity. I guess milk is a commodity, but meat is even more of a commodity,
Very
where
true.
it's less brand focused, or potentially less brand focused, unless it's novel alternative proteins. But if it's old school chicken, that's pretty no-name branding. And so it seems like maybe that's harder to compete, but Oatly can outcool everybody.
Very true.
Yeah, so we'll see if that has any meaning in China. Do you think Oatly will maintain its footprint in China, or it's really scaling back?
No, I do. And I think that right now what the focus is, the focus is really on making sure that they're focused on producing the right product and selling it in the right places. So the strategy has been into like coffee shops, right, and where it can be used as an additive for coffee, right? So I think that they've got the right focus. It just takes a little time to change the way your operations are running.
Sure, of course. Well, with Beyond Meat, I really love that steak product, and I had hopes that that steak product was going to push their stock price up, but they did come back with revised earnings such that it's still going to be a little while before they're profitable. And I think that's the one lesson that I really take away from the companies that rushed to IPO, go to initial public offering on the public markets. Unlike the venture world, where everyone's enthralled with the big idea and the dream, the public markets really want to see profitability, and they really want to know when you're going to have revenue and profitability. And until you feel like you've got a solid roadmap to deliver on that, it's probably too early to go public. Would you agree?
Yeah, I absolutely would agree. And when Beyond Meat and Oatly went public, they were treated more like a tech stock than a
Mm.
food stock, right? And that in tech stocks you don't have to show a profit, right? That's kind of the way they trade.
That's
And then
cheating.
some,
Wait a
and
minute.
then people came along and said like, but these are food companies, right?
Mhm.
And so the allowance for that freedom was very short-lived compared to other sectors. And so that's when investors started saying, well, what about margins? What about profit? Like what about profit? What about cash? Like, and those are the questions where that there was, I don't think, any doubt that these companies would get there, but the time frame got accelerated on them by investor expectations. And so that's really been one of the key things. And what we've seen, unfortunately, right now in the private markets is that it's harder and harder to raise capital, right? And so for startups, the funding is getting harder and harder to come by. And so, if there are brands out there that are developing, even for venture capital, or for private equity investments, there's a much higher expectation of a clear path to profitability and a
Mhm.
clear path to positive margins,
Mhm.
and that wasn't as much of a part of the conversation even 2 years ago.
Right.
So the climate has changed at all stages of the markets, and it does make it a lot harder for some of these companies to grow and to get funding in order to spur further growth.
Yes. Yeah. So it really, that roadmap to profitability is key, and the excitement just isn't there in any business arrangement like it was 2 years ago. So the
Right.
cash isn't there because the excitement isn't there. So it's really just kind of
Yeah.
show us the money,
Mhm.
and that's okay. That's a proper business that can withstand the test of time anyway. So
Right.
that's okay. I had some high hopes that the PepsiCo Beyond Meat arrangement was going to give Beyond Meat better distribution channels, better relationships there. And that seems to just sort of petered out. I mean, the Beyond Meat jerky still exists, distributed through PepsiCo, but I don't know. Have you seen any meaningful difference in the business model because of that relationship?
Not really at this point. And in fact, it's been interesting to see that Beyond Meat has really been focused on bringing the manufacturing of the jerky product more in-house. And so I think they bent over backwards to get that product out on a very fast time frame, and to get it out into all these stores through Pepsi's distribution mechanisms. But in the attempt to do that, it ended up costing a lot because
Yeah.
it wasn't the most efficient production process. And so now that JV seems to have kind of simmered down and quieted down a little bit, but and Beyond Meat seems to be pulling a little bit more of that internally. But ultimately, that's probably a good thing because it gives them a little bit more control over the product, you know. But it did cause some it did cause some ups and downs with regards to their financial performance early on.
Yes, it was an expensive partnership in many ways. It wasn't an efficient production schedule. I'm happy to see them bring, without ruining that PepsiCo relationship, I'm happy to see them bring the manufacturing in-house. They've got the capacity
Yep.
because, sales on other things aren't what they were supposed to, so there's some room there to bring that in-house. I think ultimately that's good. And I ultimately believe in both of these businesses, Beyond Meat and Oatly. I do think it's like you say, it's a question of letting the test of time, giving them enough time to have all of these plans really play out. These are some growing pains that sort of make sense in any environment, let alone a supply chain challenged environment, a recession, inflation challenged environment.
Yeah.
So that
And
maybe brings, oh,
yeah.
please.
Oh, sorry, I was gonna say, and as you said, they have some phenomenal products.
Yeah, they do.
But they are facing they are facing issues right now about consumer perception, and the consumer perception about the health qualities. That whether these products really are better for you than the conventional proteins. And there's been just a lot of chatter about the production methodology, and that it's over processed, and that it's not a natural product. And so, I think that there's been, that's been a difficult environment to operate in and to try to navigate, as there have been there's been a lot of pressure on like from external groups saying, well, this can't be better for you. Look at the manufacturing process, and if you can't understand every word on the label, it's not healthier. And so some of those benefits that were attractive to consumers early on are now under question, and unrightfully so. And it's going to take time to kind of re-educate consumers on what the benefits of some of these products are. And then that's when you'll start to see people returning to the category and maybe a little bit more of the growth.
Mm-hmm. For the record, this is my entrance into, eating healthy is a spectrum, and it's pretty clear Beyond Meat isn't a carrot. It does come in a box. It does have a UPC code, but it doesn't have induced trimethylene N oxide, which meat does. It doesn't have cholesterol. It doesn't have antibiotics or hormones. It doesn't have animal heme, and it has some fiber and lower saturated fat. Now, meat has no fiber. We have these long intestines, and meat has no fiber to move through. This is why, according to NIH and also the World Health Organization, processed meats, yes, meats are processed. Processed meats, a sector defined and created by the meat category, is a class 1 carcinogen, also a leading cause for heart disease, colorectal cancer, and diabetes. So is it a carrot? No. Is it better? Yes. But let's also be realistic about who's eating a hamburger. That person is not going for a salad. That person never thought in a million years that they grabbed a hamburger because it was healthy. So, right. It's not meant to be a salad. It's not catering to the salad desire. And even though I like lentils, I'm pretty sure the world isn't switching over to lentils. So it seems it's been a little bit of an unfair criticism, because the person who may or may not criticize it for being not perfect doesn't really want anything perfect anyway, because they want the taste and the fat. So,
right.
So this is the world we live in.
And it's true. And it's you talk about Mission Impossible, right? Where, the consumer wants things to taste exactly the same as a conventional meat. But I guess, and this is my personal opinion, but it doesn't have to be exactly the same as long as it tastes good.
Right.
And that's the mental shift that I think we still need to see a little bit more of, which is that it doesn't have to be indistinguishable. It just has to taste good. And if it tastes good, it can taste a little bit different, but that's okay, because you enjoy the way it tastes. And so I think there's been a little bit too much focus on having the 100%, replica, and that in every way, whether it's the taste, the mouthfeel, the juiciness, like whatever it is, you're almost setting yourself up for failure, because it's we can eventually get there, but in today, like as of today, let's focus on where that taste is really just good, right? Mm-hmm. And you mentioned like the Beyond Steak, that tastes really good, right? Does it taste exactly like steak tips? No, but that's okay, because it tastes really good, and so that's the part where I get a little frustrated sometimes, is that maybe there's a little bit too much focus on being a perfect replica, and maybe we need a little bit more direction in, like, let's just make things that taste really good to people, and that will help stabilize the category.
Yeah, I think we're in a really fun time, because as that negative press has subsided a little bit, and the press is coming back with a story they were telling before the meat industry went on to really attack the sector. The press was telling the story of the environment and how the leading cause of deforestation is from raising animals. 41% of our tropical deforestation, which kills biodiversity, is from raising animals and grazing them for food. 32% of the world's global methane emissions, again, coming from animal factories. So hard to impact climate change in the time that we need to do it if you don't address this big problem. And this is coming out more and more in the press, as well as, even if it's not getting the big headlines, there is more and more innovation happening with places like Sodexo, Aramark, these large food service organizations that are getting younger kids in universities exactly what they want, which is food that's better for the planet and better for themselves, and kind of not the same dinner that their parents had. So there's a bit of a cool factor there. So there's just more understanding. I mean, in a way, the negative press it did make everyone aware.
Mhm.
Maybe, there's that saying, no press is bad press. I mean, it's now kind of lost its allure of attacking the plant-based sector. And it's just one of the things on the menu. Sometimes you grab it, sometimes you don't. It's part of
Yep.
a plethora of options. And so the more innovation that comes, the more options we have, the more we get away from just a burger or a sausage. But we have these hybrid products and just more and more options, from the lentil burger to the fatty burger to the hybrid burger to the grass fed to the cultivated to the regular factory. It's just going to be one of the options on the table, and more people will choose the ones that taste better, the ones that are better for the environment, and the ones that have the best cost. So
Right.
when will we get to price parity, Jen?
Well, I think that if there's some good news out there, it's that the animal proteins are, especially beef, the prices are not going to come down anytime soon, right? So
No.
there's a whole cycle going on with with beef, where supply is limited, and the supply is limited for a bunch of different reasons, including drought. They've culled the herds because of that, because the cows are more expensive to feed. And so then what happens is, you've got a lower supply, and what does that mean? It means higher prices.
Mm-hmm.
So the opportunity right now for companies that are doing some of these, products like, burger type products or crumbles or the ground, and sausages, is that the conventional meat prices are still going to stay elevated for a while. And this is the window where you can say, okay, how do we bring that cost gap a little bit closer? We had a really hard time with all the food inflation and seeing that gap widen instead of close. But food inflation is starting to slowly abate. It is starting to still slowly come down. And that, in combination with higher animal protein prices, I think is a really unique opportunity that hopefully we'll see a little bit closer to parity. Exact parity, I think we're still a little ways away, at least on a consistent basis.
Mm-hmm.
We could get there with promotions or discounts, but that's not a long-term sustainable model, right? That's kind of a short-term, get people in to try it or show them. But when I look out over the next few months, there's a nice opportunity to keep narrowing that gap. And when that gap narrows, it makes it easier and easier to pull people in for trial or to get repeat purchases back.
Mm-hmm. In addition to, the products just keep getting better because
Exactly.
they're at the very beginning of an innovation curve, whereas
Right.
factory meat is really at its tail end. And as you say, the droughts, particularly as it pertains to cows, means there were less herds. Many of them died. That means skyrocketing beef prices. So the time is now to maybe shorten that price gap. But what does it do to your overall projection? So early on, I want to say it was
Mhm.
2021, Bloomberg said, oh, we predict, oh my gosh, Jen, I think it was 166 billion by
30.
2031, 2032,
Yeah.
2031 in there. What does this do to your projections now that we know that the sector is more than Beyond Meat and Oatly? What does it do for the future projections?
Yeah. So we're actually in the process of recalibrating our forecast, really to reflect the current environment.
Mm.
We're still big believers in the long-term potential of plant-based. Our original forecast was only at retail, so it didn't take into account food service, and it didn't take into account that business to business or ingredient
Yeah.
type companies. And so, when you're looking at retail, things have been slow, volumes have been a little bit down, but when we're looking at, we look at data from Circana, which it used to be called IRI, and
Yeah.
that's scanner data from stores. And when I look at the 13-week trend on alternative meat, things are improving. So sales are going up just a little bit, but volumes are holding steady. So that to me says maybe we've hit the bottom and that we're
Mhm.
ready to rebuild, right? And on the dairy side, sales are up, volumes are still a little bit under pressure, but um, you know, we've been expecting a point this year when we're looking at difficult comparisons to last year because of high inflation, that we would start to see volumes improve, and we may be starting to see that. So for our forecast, this we're already more than halfway through 2023. So in terms of expectations for 2023, In terms of sales, it's probably up a little bit, but essentially flat. But it looks like we're getting to the place where 2024 could start to grow again. It'll probably be at a slower pace than we originally anticipated, but with any type of product like this, you're going to have a slow build, and then you're going to have a spike, right? And so we think that we're still part of that slow build at this point. And so I don't have a number I can share with you today on what we're going to hit by 2032, but we're still very optimistic that this is a long-term shift that will happen. And we're just in a very, there've been a whole set of circumstances that have dampened growth at the moment.
So Synthesis Capital and the SCurve Adoption is something we talk about a lot on this show, and they see kind of a slow growth in 2024, 2025, coming into price parity around 2026, 2027, and hitting kind of a tipping point around 2032, where a tipping point, I mean, is 10% or more basically being enough to kind of push the dominoes and there's no going back. And so you have a shift that happens over the years. Certainly you don't go from 10% to 100%, but the shift has a strong hold and will take place in full. Would you dare to venture a guess about what the early 2030s look like?
Well, when we did our original forecast, by 2030, we were still looking at only 5% of total protein being plant-based. Wow. And that was still, $160 billion in sales at retail again. So I think that 10% by 2030 might be a little hard to achieve, because that is just 7 years away, right?
Yeah.
So, but I do think that by the time we reach 2030, that a lot of the noise around the sector will have subsided, right? So I think there will be much clearer understanding of health benefits, of environmental benefits. I think that we'll have companies that are in the pure play space that are making a profit, and that are pointing the way and paving that way for more companies to join that stream. And so I do think that you'll see a big uptick. Not sure we'll hit 10% in 2030, but I would certainly like to think that we'll be in the mid to high single digits in terms of total global penetration of plant-based versus conventional.
And that's not too far away from your original estimate, which was about 8% by 2031. And Boston Consulting Group says 11% by 2035. And Synthesis Capital is right along there with them, give or take. But it's interesting to hear you say this, that you haven't really backed off of your projections, so to speak. And not only will we have more innovation, more companies getting in, more pure plays, the pure plays will have revenue, they'll be profitable, there'll be more understanding from the consumer, there'll be more education, that environmental story will be so solid, that health story will be understood, and governments around the world will be investing in food insecurity. Absolutely. We didn't even talk about that here. Whoever owns food IP has a lot of power. Food and water, I firmly believe, we've talked about this on other episodes of this show, will be the wars of the future. So feeding China isn't going to happen with animal agriculture in and of itself and a growing population. And you can't trade with your enemy. You can't take a strong stance in trade talks with your enemy if they control your food. So food independence, food insecurity is going to be a big part of national security. So that's a whole nother part of the equation.
Yep. I just want to say, that, there was a Bloomberg Business Week cover story that plant-based is dead. And I just don't share that outlook. I look at the companies, I look at the space, I look at the trends, and I think that a little bit of softness today does not translate into, the fact, like, it just doesn't translate into this is never going to materialize. I think that with any growing industry, you have ups and downs. But again, in terms of our forecast from Bloomberg Intelligence, where we see this going, we're seeing, the commitment to the space through a variety of companies, that it's across the entire food supply chain, and that ultimately this is something that is going to meaningfully be able to help change the way we eat.
What a great place to end on. Jen Bartashus, who is the senior analyst for plant-based innovation, as well as other big box food chains, food and other products chains. Jen Bartashus from Bloomberg Intelligence, telling it like it is on the Plant-Based Business Hour, always keeping us updated. I like to have her back about every quarter, so she goes over the earnings calls from Beyond Meat and Oatly and gives us her impression of the sector and where it's headed. So, like always, Jen, thank you for being on the Plant-Based Business Hour. I so appreciate having you and love your expertise. Before I let you go, what is your go-to snack?
Well, my go-to snack changes from time to time. At the moment, it's hippias, which is it's a white cheddar chickpea puff, and it's a great snack. And I'm actually allergic to corn, and so anything that is like one of those puff snacks has been off limits for a long time for me. And so the fact that it's made of chickpeas and rice flour is pretty amazing. So.
Oh, that's awesome. Okay, I'm going to have to try them. That is wonderful. Okay, so a chickpea puff is your favorite snack. I love it. Thank you again, Jen, for being with me. Always fun to have you. Jen, don't go away, but everybody else on Facebook, LinkedIn, YouTube, and Twitter, I will be back in the fall, which, yikes, is next week on my regular schedule every Tuesday, 1 o'clock Pacific. It's been a little funky during the summer, but I'm back at it come fall. So thanks, everybody, for all you do, for caring about this subject. And remember, you can do investing in the public markets to impact the global food supply system away from animal proteins. It's not just the startups who may or may not make it. It's also what's going on in the public markets. And I like to bring you all the news here. Thank you, everybody. Thank you, Jen. And I'll see everybody next week.